Welcome back. Today on this series, we're going to explore a little bit about extraordinary gains and losses. What are they? Why are they important? And why does it matter to you? So, business is a cyclical process. Everything kind of runs like Groundhog Day almost. And the recording and selling and shipping of goods and dealing with customers and expenses and revenue and all those things create ordinary profits and losses. And that's just the normal day to day transactions that the business goes through. So, what happens when there's unusual disruptions like changes in the business climate or significant changes to costs or restructuring or disaster strikes? Accountants are faced with reporting those types of gains or losses as well. And GAAP, generally accepted accounting principles, provides certain rules for reporting those types of activities as either ordinary or extraordinary or extraordinary. And some extraordinary things that can alter the income statement, for instance, are downsizes or restructuring where you eliminate a business line or a business unit, and that could be treated as a restructured um, discontinued operations line on the income statement. So you've got your normal GAAP income statement with your statement of profit and loss, and then you've got a profit or loss from discontinued operations reported separately, and that's part of the process of being able to segregate ordinary from extraordinary. The purpose is really for one of two reasons. One is to separate out the ongoing normal behavior of the business and be able to analyze that with a little bit closer eye toward what should we be expecting in the future. And then the other part is to be able to really take a look at that extraordinary item and determine if it really was extraordinary or not. So it serves two purposes. One, to kind of set the extraordinary item over to the side and say, hey, take a look at this. This was something unusual. And two, take a look at this. This is what we expect the normal operations of the business to be. So you got these two components that are set up so that extraordinary items make sense. For companies like and the example that I've got in the text down below is Western Union. Western Union, if you watch all the old movies and things like that, they used to deliver telegrams, and they delivered their last telegram about 5 years ago, and they're no longer delivering telegrams. No one does telegrams anymore. So when they eliminated telegrams, they could set up a discontinued operations telegram operations and report the gain or loss from the closure of that business separate from their MoneyGram business or from their um, other money transfer businesses. So the change in the business condition required them to discontinue an entire business line, and that became an extraordinary item for them. Um, if you're in a normal, operation where you're selling clothes, let's say, and you discontinue selling jeans, that's generally not going to be discontinued operations because you're still operating the same thing. You're just making changes within it. But if you're making a dramatic change, like you're shutting down, you have Barnes and Noble, and you've got a combination of online bookselling and offline bookselling, and you've got Barnes and Noble owned licensed Starbucks in each of the stores. You might have to report those as different segments on your financial statements, and then if you discontinued one, that would go into discontinued operations. The other thing that tends to show up in extraordinary items are lawsuits and legal actions that can cause significant losses or gains as well. So you may see, for instance, with going back several decades, smoking legislation, and the tobacco companies paid billions of dollars into the states in order to be able to pay for liability associated with smoking. That is really an extraordinary item to their continuing operations of that business. And so that would get reported as an extraordinary item. Your legal fees are reported as an extraordinary item. And if the states were to report, they should report that income as an extraordinary item, as opposed to normal tax income from sales taxes, property taxes, and income taxes. So one of the most important aspects of any business is how the financial statements end up presented to investors. Sometimes changes need to be made, and businesses must report any errors that they have found, and they do so when they provide what's called a restatement of the financial statements. And in that restatement, they're going to itemize out what was restated, what was different from what they originally did, what did they find as a mistake, and how did they report it. And sometimes those restatements cause things that were extraordinary items to now become ordinary, and ordinary items to now become extraordinary. So if you see a restatement, that should be an amber, if not a red flag, that you've got not only accounting issues that you need to be looking at from a controls perspective, but what happened in that change, and did it create something ordinary from extraordinary or vice versa? Because that could tell you something about the ongoing business operations. Not only that the accounting might have some challenges, but the ongoing business operations might have some challenges as well. So keep your eyes open for restated financial statements and kind of what they're restating, and whether any of that was from ordinary to extraordinary or vice versa. The other thing that you'll see is companies sometimes change accounting methods. So they'll go from one type of inventory method, specific identification, to another, LIFO or FIFO. And when they do that, they need to report it as well. And sometimes it's reported as an extraordinary item, and sometimes it's reported as an ordinary item. And GAAP will tell you what those rules are. Just keep your eyes open for anything that doesn't happen year after year after year. And if you see anything, whether it's in the extraordinary item line or whether it's in the ordinary line, but it doesn't happen year after year after year, that's an area to kind of focus on, particularly if you're acquiring a business. And if you're selling a business or you're running a business and your accountant presents you with those financial statements, that's really where you need to start asking a whole bunch of questions. The other piece is understanding that you may have one-time losses or gains buried in the financial statements. And they're ordinary for GAAP purposes, but they cause a lot of variation in the performance of your company on either the sales line or the expense line. So ask questions when you see variation in performance as well. These are just a few of the unusual things that you might find on a P&L statement, profit and loss statement, that should be separately disclosed and reported, or at least you should be asking questions about if you're looking at financial statements and you see anything that looks a little bit odd or a little bit off. Don't just take someone's word for it, and don't not ask the question. Dig in, try and figure out what's going on, and it's going to serve you well in the long run. You want to understand and manage the normal operations of the business, and you want to understand why something is treated as extraordinary. Because, little secret, if you see an extraordinary item every year, particularly in smaller businesses, but if you see extraordinary items every year, they're probably not extraordinary. Like I said, if you see things recurring year over year over year, that tends to be more of an ordinary course of business transaction. Anytime you see extraordinary, you should be diving in to understand what's in there. Is it really extraordinary, or did they try and hide something ordinary down in the extraordinary line to make the ordinary income look better? And is it likely to recur again, and what was the reason for it, so that you can understand some of the risks associated with that business as you drive to FI. Until next time.